Hi, and welcome back to the show. I want to spend a little bit of time today talking a little bit about taxes. Well, first of all, Matt, let's talk about the history of taxes. Why did it start? Where did it start? Is it supposed to go away or something?
Yeah, a lot of people don't realize, but we didn't start paying any federal income taxes in this country for a long, long time. It was actually 1913 when we first started paying some federal income taxes. Basically what happened was in 1912, Congress came to us and they said, okay, we've got a little bit of debt. We're having a hard time getting paid off. They said, we're going to have this federal income tax, but there's two promises we're going to make you before everybody gets real upset and angry with us. A couple promises. First, they said that this tax is just going to be temporary. As soon as we get this debt paid off, we'll eliminate the tax.
Right.
And then the second promise that they made us was they said that nobody will ever pay anything greater than 5%.
Which we're below that now, right?
Yeah. Right. So, they said nobody would ever pay anything more than 5%. So, does Congress ever keep their promises? No, and this was another area where they certainly did not keep their promises. So since 1913, obviously we've had federal income taxes, and it didn't stay at 5% for long.
Yeah?
And they increased it pretty rapidly.
What was the highest? I heard it went up over 80 or 90.
Well, that's another surprise that a lot of people don't realize, but the highest income tax bracket we've ever had in this country was 94%.
94%.
94% for 2 years.
Good gosh.
Back in the 40s. And between the 40s and the 50s, we spent an entire decade at 90% or higher.
You know, I read somewhere that it was about Ronald Reagan when he was an actor, about how he was right on the cusp, and it seemed like if he acted in 2 movies, he made more money than he did in 3 movies.
Well, it was he talked about in his biography that he never made any more than 2 movies in a single year, because at the time he was getting paid about $100,000 per year. I'm sorry, $100,000 per picture. And if you made more than $200,000 in a single year during this time period, you would pay 94 cents on every dollar in taxes.
Wow.
So once he made 2 movies, it was like...
It's over. You may as well quit.
Why work? It's actually what drove him into politics.
Yeah.
He talked about that in his biography, that he didn't think that was very fair. He didn't think that was very American to have to pay 90+% in tax. So that's actually why he went into politics, to try and fix it.
Yeah, I don't think it's fair either. I mean, taxes are something they're not going to go away. But should we start converting? I mean, I know it's been a hot topic here lately about the tax cuts that we've seen. Should clients or should our viewers start thinking about reducing their tax footprint overall, or what?
Yeah, well, one of the things that we recommend potentially is to take advantage of, arguably where we are right now, which is historically low income taxes. No matter who you talk to, everybody feels like they're
paying too much.
They're paying too much in taxes, but historically, they haven't always been 94%, but historically speaking, they've been much higher, much higher than what we have right now. And I think if you look at the changing demographics in the country, if you look at some of the issues we have with the debt or the unfunded liabilities of Social Security, Medicare, Medicaid, I would really recommend that individuals take advantage of this environment that we're in right now and start shifting as much money as they can towards tax-free options, tax-free investment accounts. So if or when taxes go up in the future, they're able to handle that a little bit better than if they have the majority or all of their retirement or investment assets in taxable or tax-deferred accounts. Dustin, most of the time when we meet with individuals in the office, the majority of their money is in things like IRAs, 401ks, 403bs, which is great that they've saved that money, but they've never paid any taxes on any of it.
Right.
So as they start to withdraw those funds, or when their heirs or beneficiaries start to draw those funds when they pass away, somebody's going to have to pay tax on it, and arguably I could see us being in a higher tax bracket than what we are right now, say 5, 10, 15 years in the future.
And on that note, if you meet with somebody and they have, let's say, a $500,000 401k, well, it's not what you have, it's what you keep. So what is that really worth? It could be worth $300, it could be worth $450. Yeah. So what should clients do to really lock that in?
What ends up happening is when you have money, whether it's $500,000 or $200,000 or $1 million in an IRA or a 401k, really what you have is you have a partnership with the federal government. Yeah. You're in business with the federal government.
Whether you like it or not, right?
Whether you like it or not, because they own part of that account, right? Yeah. Now this is a really bad partnership because the other silent partner can kind of turn the knob on how much they own of your particular account whenever they want, and you can't do anything at all about it.
We're a little short this year. Let's crank up our ownership a little bit.
Let's take a little extra tax. So, yeah, it doesn't matter how much you have, it matters how much you can keep, and so you're much better off having that $500,000 you were mentioning in something like a Roth IRA, or maybe different types of insurance strategies, or maybe municipal bonds even. So then you know, at least when you look at your account statement, you know how much money you can actually get your hands on, and you can actually take that money out and spend it and enjoy it.
Yeah, speaking on a Roth, I know a lot of times individuals or viewers may think, well, I make too much money per year, or I'm too old. It's not going to make sense for me to do a Roth anymore. Should they start, or does it make sense at this point, do you think?
I'm a huge fan of the Roth. You know, regardless of age or how much money you can put into it. I mean, tax-free is tax-free. Right.
Yeah.
And even if somebody's, say one of our viewers right now, say they're just a couple years from retirement, they should still possibly use a Roth, because nothing says that the day that you go into retirement, you have to turn the spigot on of every single account you have and start taking money out of it, right?
Yeah.
So if they already have money in a 401k or an IRA that they're going to live on, they could probably let that Roth money sit there for 10, 20, 30 years maybe, and let it grow and compound completely tax-free.
Yeah. And what it does, it really gives you options.
It creates a lot of options. One of the big reasons why we are big proponents of individuals having as much money in tax-free accounts as they can, again, and we don't proclaim that we have a crystal ball, but again, I think you can make a pretty strong argument tax rates will be higher in the future. And if and when that happens, if all your money is in tax-deferred accounts, there's nothing you can do, right? You need the money, or you have to take the money out, you're going to have to pay tax on it. Well, let's say tax rates do go higher in the future, and maybe it's a temporary environment. We're not here to argue politics on the show, but you could literally graph whether Republicans or Democrats are in control and where the tax rates are, right? So let's say at some point in the future, taxes go higher because the political winds shift like they always do. But that's going to be a temporary environment, and hopefully in 4 or 8 years, the other party can win and tax rates can go back down. If you have money in a tax-free account, you can buy yourself some time. Right. You could draw more money from that and less from the tax-deferred, and then wait until tax rates go down maybe. Then shift back to the tax-deferred account and take less from the tax-free. It just gives you options, like you said. Our clients that go into retirement, and if they have the majority of their money in tax-deferred accounts and very little to no money in tax-free, we'll recommend that they maybe start shifting some funds over, doing some conversions into the tax-free bucket, because we just want to have that option for if tax rates go higher in the future. I was going to say a lot of advisors are focused on trying to get you a little bit of return, which is important, or saving you a little bit in fees, which is important. But if the 15% bracket goes to 30% one day, or the 20% bracket becomes 40%, that's going to have a much bigger impact on you than 1 or 2 percentage points better return.
Absolutely. Now, would you say that Roths are the only option as far as tax-free, or what other options?
Not the only option. Obviously, you have the Roth IRA, and some people will have the Roth 401k if their employer offers that. But no, there's different insurance strategies that will grow tax-free as well if you qualify for them. And then municipal bonds, even though they're not paying a whole lot of interest right now, the interest that they are paying is tax-free.
Now, I know some viewers may think, well, life insurance, they hear that word and they may be scared away. I mean, are all life insurances built equal, or do you want to explain a little bit?
No, there's what's referred to as investment grade accounts, which is if somebody's looking to do some conversions, that's what we would recommend. There could be a couple of reasons why someone may invest in a strategy like that. One, if they need the coverage, but if they don't need the coverage, but they would still like their money to grow tax-free, then you can go with an investment grade plan that'll grow tax-free but still be able to provide some good returns.
Great. So if you have any questions about how to reduce your tax footprint over your lifetime, feel free to give us a call at our office. We look forward to talking to you.